And this morning we have Liu Li-gang, head of Greater China Economic Research at ANZ Bank, joining us in our Hong Kong studio. Good to have you back. What about FDI? What are you watching out for?
Well, FDI number is not a significant number for China anymore, but it's a useful gauge on how much capital inflow this month will have. Usually we know that FDI, trade surplus, as a major component of China's net increase in foreign exchange reserve. So a huge FDI inflow, that means China will continue to experience high foreign exchange reserve. As a result, that it's a big challenge for China's monetary policy.
Yeah, big challenges right now for China. So FDI, you said not important anymore for China. So what is important? CPI, obviously?
Indeed, I think CPI is very important.
Okay,
we know that CPI last month was higher than the market expectation.
Okay, but with more foreigners putting their cash and investing in China, will that continue, some would say, to inflame inflation?
That's true, because FDI at this moment is a kind of capital inflow that will add up to China's foreign exchange reserve. We know that China's foreign exchange reserve has already reached 3 trillion. How much more do you want?
Yeah.
And actually, China is actually encouraging capital outflow rather than inflow.
Mm-hmm. So what can China do right now to try to keep its economy in check, to calm inflation?
I would say that China should continue its current monetary tightening, although we have seen some moderation due to policy-induced tightening. And this is just the beginning. The PBOC need to carry out its tightening move.
Yeah, we heard from Goldman Sachs and Deutsche Bank saying that they expect one more interest rate increase, but they're just one more interest rate increase. What are you expecting?
Well, I think going forward, the interest rate will continue to be used. We actually expect 2 more interest rate hikes. Meanwhile, the PBOC will continue to use reserve requirement ratio to withdraw liquidity, and also they will use open market operation to withdraw liquidity. At this moment, you know that all these reserve requirement ratio measures have their effect have become diminishing, because how high they can go.
Right.
This then lead to the question whether China would use the foreign exchange policy to contain inflation, especially when imported inflation is a big problem for China.
Yeah, that's right. Are you going to do something about the CNY, which is very political, as we know? So, you know, I was talking to Adrian Mowat earlier on of JP Morgan. He says if you really, really want to control inflation in China, control the rates that the economy grows. But right now, it looks like China's all about pro-growth.
Indeed, you know, some people seem to mention that China's economy may slow significantly. We do not agree with that assessment. The main reason is that inventory build-up actually is returning to a historical average, and that means as China's economy rebounded strongly, inventory has to return to the mean. Meanwhile, industrial production has slowed a bit, but that may be due to power shortage. On the other hand, if you look at residential housing investment, in the first 4 months, we have a 38% increase year on year. Meanwhile, China intends to build 10 million public housing units. So you can see that the underlying economic activity in China are still very strong.
Yeah, continues to be there. Okay, Liu Li-gang, thanks again for spending time with us and seeing you right here in Hong Kong. That's the head of Greater China Economic Research at ANZ Bank.